Guys, Michael Livingston here. We're going to be going over scalping. Congrats to all you guys actually hopping on. It's a Saturday night, 8 o'clock. I know a lot of people are out, partying and stuff like that. So congrats to you guys. But I am recording this so that way other people who couldn't hop on for some other reasons, they'll still be able to watch it. So basically what we're going to be going over is how to scalp the market. Now, scalping basically means like, you're going to be in the market for anywhere from 15 minutes to maybe 2 hours. In and out with about like a 10 to 15 pip max stop loss, and then your take profit's going to be about 15 to 20 pips also. So your risk to reward ratio is about 1 to 1. You want to shoot for 20 pips and shoot for 10 pip stop loss. Those are your best trades. A lot of them that I was just looking at recently, the stop losses could have been seven pips, and you'd have been fine. So that's basically what it is. You can use this method that's called divergence. Even on an hourly time frame, you just got to be more patient for it to go the way you want it to go. But first things first, what you're going to need to have is an indicator called Relative Strength Index. What I say for short term is RSI. And the way to add that to the chart is, I don't have it on here yet, so that way you can see me set it up, is you go up here to the top screen where it's got this squiggly line that says Indicators, Strategies, and Economy. You guys see that?
Yes.
Okay, cool. So you click on that, and then you can go into this little search bar, type in RSI, and Relative Strength Index should pop up. So right there, you click on Relative Strength Index, and you can exit out of this screen, and then as you can see, it popped up down here. Now what you want to do is double click on it, and then make sure it's on style, and then you can you're going to want to change this number right here where it says 30 to a 25. And then what I like to do is, they've got the lines gray. I'm going to make mine red. It's up to you. You can make them whatever color you want. And I actually, instead of having dotted lines, I like to have solid lines. You'll see what these lines are here in a second. And then you don't have to, you can keep the lines skinny like this. Or, you can move them up to make them thicker. You can go even thicker, but you don't really need to. I like to just put it here. My personal preference. So are the colors. Those are my personal preference, but you want this number to be 70 and this number to be 25. And then once you're done with that, you can just click OK. Now, what the relative strength index means is when price is overbought or oversold. So when price is down here, they're basically telling you that the selling momentum slowing down and that the market should go up. Now, as you can see, like the market basically follows, like if can you guys see this cursor right here? How it has a dotted line that goes all the way up to the to where it is down here. Can you see that? You see how this dotted line goes all the way up to where the candle's at? And it matches down here. So basically what I'm showing you is that it just corresponds to what's going on right here. And as you can see, that it tends to do exactly what it does down here. On the graph, it does down here also on the RSI. But what we look for is divergence. And what divergence means is when the market is showing you something different than what the actual indicator is. So it'll literally be reverse. And for instance, here's one right here. If you notice, if you draw a red line from this last low to this high, and if you go down here and go to the relative strength index and match it up, right here, if you go all the way down, it's this spike right here. And as you can see, it's the complete opposite way. Now that's showing you that the market is tired, and it's showing you that the market is about to come down because a lot of the buying power is going away, and also you're seeing divergence, which is showing you that's the definition of divergence, is when the market is trending this way on the relative strength, which is the opposite way of the actual market. Can you see that difference right here?
Yeah.
Candy, you can see that? Keel, do you see that?
Uh-huh.
Yes.
So you see how that's different? Now, if you go and then you see how the market just shoots down. Now that was indicating that all the buyers were getting out of the market. Now, if you notice, it usually isn't like that. Like right here, this low to this high, if it'll let me draw the line, if we go right here, it's the same. Now that's not divergence. That's not divergence because it's the same. Okay? So that is not divergence. Now I'm going to go
Like
down.
both charts are almost exactly the same except for where you mark up.
Yeah, like it should look exactly the same, okay? But if it's different, like this for instance for this one where it's going down and this one's going up, that's showing you that it's about to go down. Now, vice versa, if it was doing it down here, which I'll find some examples, then that means it's going to go up. But as you can see, the trend right here is down, but right here, the trend is up, the last two highs. You see what I'm saying? Now, that's divergence. This isn't divergence, because usually it's going to look exactly like the chart does. As you can see, this one does. You see how it goes up, down, and up. This one goes um, up, down, and up. So that's not divergence because it did exactly what it did on the chart. Now, I'll find some other examples, but you can use this on the hour chart and still scalp, but what I like to do is I like to hop on the 15-minute and I like to hop on the 5-minute chart and do it also. I was showing Candy some examples earlier before I started this, and we can kind of go back and look at them. Some of them were buys and some of them were sells. I think I highlighted them. Because if you notice, like we'll look at, and you'll notice like the market is doing what it's supposed to. Like right here, it was lower. Right here, it was higher. So that's not divergence, right? It looks exactly the same as the market. Let's see if we can find some divergence. Let me remove this line. I'm not sure what that was. Delete. These lines just went crazy is what happened. I see. Alright, delete. Delete. Alright. Here is another example of divergence. If you see this trend right here, this low and this high, now if you go down here and you do it, it's actually going downwards. So that is an example of divergence, and as you can see, once that divergence formed right here, you could have hopped in for the sell and caught a quick, 25 to 30 pips. And when you get in these trades, say you got in right here, you would put your stop loss like 4 or 5 pips above that wick up here. So you would have had a stop loss of about 10 pips. If you would have got in at 110.445, you could have put your stop loss at 110.510 maybe, and you would have had like a 7 to 8 pip stop loss. And then, you're going for that 15 to 20 pips. When you have that small of a stop loss, if you're up 15 pips. Now, usually what I'll do is I'll get in 2 trades, and then, like I always do, once it hits 20 pips, I'll move my stop loss to break even, and take out that 1 trade, and then leave 1 more trade running, and then every time it moves up 10 pips into profit, then I'll move my stop loss 10 pips into profit. So say you got in at 110.443 and it drops down 30 pips, so 110.143, that'd be 30 pips. Then you would move your stop loss down to 110.343 because that's 10 pips. And then that way you can, capitalize on 2 trades. And then if the market does continue to go down, every time it goes down 10 pips, then you move your stop loss down 10 pips, 10 pips, 10 pips. Does that make sense?
Yeah.
So
you're basically just following the market, though.
Exactly. You're just following the market down, and when it wants to come back and hit your stop loss into profit, then cool, you caught 20 pips on the other one, and then, maybe you caught 20, 30, 40 on, your second one, so you caught a total of 60 pips in the matter of, 30 to 40 minutes, and then you can be done for the day. And then you can do it the next day, and then the next day, and then just say you catch, 50, 60. You can do this. We can find trades like when we do these live webinars. Like I'm gonna do them on Tuesday. I'll probably try maybe do it on Monday, but I really don't like trading the markets on Monday. But we'll be doing these while we're waiting for our other setups, my other trading strategy, where we wait for the breakout and then the retest. As we're looking at those trades, after we get that all done, then we'll hop on and we can do some scalping. So I'm going to want to do that Tuesdays, Wednesdays, and Thursdays because that's when the market moves a lot. And, I'm trying to find the best time, but like the best trading time is, around 9 o'clock to 10 o'clock Eastern time. Because the market's open at, I think, 8:30, and then it seems to, like, go one way, and then once we find a divergence on a certain pair, then we can get in, either for the sell or for the buy. Now, so far, does anybody have any questions? I'm going to look for more examples, but so far, does anyone have any questions?
No, I don't.
Okay, we'll continue, and we'll look for some more areas of divergence. Now this right here is I wouldn't have traded it, but it almost is divergence because as you can see, the market is trending up right there, and then right here, if you match it up, it's slightly, if not almost the same. And then as you can see, the market tanked. I mean, wow.
So you say that's not considered divergence?
40. No. It tanked 40 pips. I mean, it almost is. I can't really tell if that little dip right here is higher or lower than this one right here. So I don't know. I necessarily probably wouldn't have traded it, but as you can see, the market is literally going sideways or down, but up here you see that big move up. So that took a lot of the sellers out, and then, obviously we would have hopped in right here, and if say you would have got in right here after the divergence formed at 550, stop loss just up here at 616 or 620, that's a 7 pip stop loss. Let's see. Find some other ones. See, like this isn't divergence. I mean, it did exactly what it said. If you follow the dotted line as I move this cursor, you'll see it went down, it went up, went down, went up, and it went up. Like nothing changed, And you don't want to look at divergence here in the middle. That doesn't count. You only want to look at it when it's at around the 25 or the 75. And the 75 is the marking that I said to make right here. Actually, no, you want to keep it at 70. My bad. 70 and 25. Now this red line right here is the 70, and the red line down here is the 25. I think there's another one over here or something like that. So right here, you can see the market. I can even delete it so we can redo it. Delete. Delete. So right here, you see a spike down and then a spike up. Now right on the chart, it is trending upwards. Now if we go down here So if we follow it down, and even the dotted line shows you where it's at, right here, and draw your line, it's completely different. And as you can see, the market fell about 20 pips. And then you could have had your stop loss just above, like I say, 3 to 4 pips above your wick. So say you got in right here at 110, at 0.110, you could have put your stop loss at 0.16 to be safe, and you would have had a 5 pip stop loss. So this is minimizing your stop loss and enabling you to, almost have a 2 to 3 to 1 risk to reward ratio each time. Let's see if we can find some other areas, even on the buy side. See, right, like this is how I check them. Like here, nope, because it did the same. It did what it said. Here, nope, it did what it said. Here's an area. Okay, so right here. Market went like this. And if we go down here and look at the RSI, match it up with the dotted line, go down, draw your trend on here. As you can see, it went up here and then it immediately dropped 0.984 to 815. So almost 20 pips again. And you would have had a stop loss of about 7 pips again. So your risk to reward ratio right there is 3 to 1. Let's see what happened right here. What happened here? Nothing. Right here, here's an example of a buying one.
These changes occur literally within like a minute, correct?
As soon as the candle forms, that's when it counts. And that's when you'll see the divergence in real time. That's why, it's going to be important to hop on for at least a couple of the live sessions so you can see it happen live. But it will literally look like that before the actual move like that happens. So, for instance, this is a buying one. If you match it up right here, it goes from here to here, and then on here, I gotta scroll over because of this thing, but if you match it up, if you go down, if you go down from here, it's right here, and then you draw your line, then you can see it's the opposite, so then you would know to buy the market. Now this one you might have had a little bit bigger of a stop loss, 0.429, 374. So that one, I'd go a little bit lower probably. I'd probably go at 369. So that one you would have had an 8 pip stop loss, 8 to 9 pip stop loss. But it would have still been a good trade. As you can see, it went up over 20 pips. Honestly, if you would have, and then your second trade, as you can see, you would have cashed out on about 30, 40, 50 pips, depending on how long you kept it in and where your stop loss at break even was. Oh, here's another one. So as you can see, you follow your cursor, make your trend line. Oh no, this one isn't divergence. This does exactly the same. See, this is an example of this isn't divergence because it did exactly what it said. That's not divergence. So that is not divergence right there. My bad. But at least you can see, that what divergence isn't. Let's see, is this it right here? Yep. So as you can see,
But it looks like it went kind of down, not up though.
okay, look. So you see this mark right here? You see that?
Yeah.
So if you follow that right here, make your trend line to the next point right there. That matches up with this right here. So this one went that way, heavy, and then this one went down.
That's divergent.
What was that?
What's
What?
Divergent?
That was Divergence, right? Is that what you're saying?
Yeah.
Yeah, yeah, that's Divergence. Yeah, the other one over here that I almost said was Divergence wasn't. Yeah, this one's not Divergence because as you can see, it did exactly what it did on the RSI as it did on the chart. But right here it did the opposite, which meaning Divergence. And as
Right.
you can see, it dropped from 729 to 550. That's another 20 pips with a minimal with about a 7 pip stop loss. See if we can find some more. And then, like, you can even do this on the 15-minute chart. Let's look for some areas of divergence even on the 15-minute chart. And that will be even more truer than the 5-minute. Let's see if we can find some divergence on the 15-minute. You can find it on the hour chart, 15-minute, whatever. Delete. Is this it? Nope, that's not divergence. Nope. That's not divergence. Nope. Oh, is this divergence? From right here to right here. It looks like that's divergence that would actually been a losing trade. If you draw this line from here to there, and then draw this line from here to there, that's completely opposite. That's divergence, right? You guys see that? But as you can see, that one didn't really drop 20 pips. There's an example of it actually, probably hitting your stop loss or coming close. But you would have put your stop loss just above the wick. So technically that trade still you would have made profit off of. It just didn't shoot down right away. So if you were watching the trade and got scared and didn't wait for it to hit your stop loss, you could have panicked and got out of the trade even though you were only down 5 or 6 pips. So that trade ended up, if you draw it going, farther, it did end up, dropping compared to this. But like say you would have got in right here and you put your stop loss just above that wick, then you would have been completely fine. But that's an example of it not shooting right down right away. So far, do you guys got any more questions, or is it kind of just a little repetitive and then you guys just want to kind of see it happen in action?
Yeah, I want to see the action.
Yeah. Because it's not totally different, but you'll actually get to see it happen live. See if I can find some more areas. No. What about no? What about here? No. It's usually after a big move down or a big move up. Looks like this might be divergence. Yep. So right here on the 15-minute chart, a really nice divergence. So you can see from right here to right here, and then if you go down here, match it up, go down, draw your trend line, and boom, divergence. And as you can see, it dropped from 221 to 909. So that was a quick 30 pips in a matter of about an hour and a half to 2 hours. And you would have had your stop loss at about 10 pips. So this might be better for people who want to use smaller stop losses and use a little bit bigger risk. Because since you're doing a smaller lot size, or smaller, only 7 to 10 pip stop loss, then you can up your lot size from like a 0.04 to like a 0.06. And if I were you guys, or this is what I do, like I said at the beginning, do 2 trades. Take that first trade out right when it shoots down like 15 pips, and then move your stop loss break even, and then let that other one ride and keep moving your stop loss down as it moves down every 10 pips. So that pretty much sums that up. It's a pretty simple technique. You just got to be patient and wait for the patterns to happen because you don't want to rush them. Because you're gonna wait and see this happen, and when you see these candles close and the divergence close like that, then you know to hop in for that sell. And as you can see, it drops. I mean, it tends to drop super fast. Like you're gonna be in profit almost, right away. And again, you're risking, anywhere from 7 to 12 pips, I'd say, per trade. And don't get me wrong, sometimes divergence can go against you. So always use risk management. Keep using the same lot sizes. Don't change anything like that. And just as long as you use the same risk management every single time, then you'll never lose money because you'll always be making more pips than you're losing. So if you keep the same lot size, then you'll have no problem staying in the profit. But that pretty much sums it up for that. I'll do another one, and then if you guys got any more questions, or when we do one-on-ones, if you got more questions about it, or you mark up some other pair or something like that, and look at it and show me, is this divergence or whatnot, then when we hop on another one-on-one, we can go over that.
Okay.
So, anybody, no more questions, or it's pretty simple. It's just you got to be patient and wait for it to happen. I'm gonna go ahead and close this, and I'm gonna end this recording. But it was nice being on here with you guys, and I'll see you guys on the next one.